You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, today we are taping Options Playbook Radio. It is a Wednesday. The date is the 14th of August, and you might want to mark that date because the market's been a little bit crazy this week, to say the least, even crazier than normal, if you will. But today, the bond yields in the bond market basically started the market going south. And the biggest thing is that a key indicator flipped on the bonds, and they're saying that there is a recession warning whenever this indicator happens. So because of that, we have the VIX trading north of 22 at this point in time. The S&P 500 index today was down 3%. It basically started down and never, ever came back and continued on down throughout the day. So I thought that we would dedicate this Options Playbook Radio to just talking about hedging your positions. And now one of the things that I find interesting is that we're in August. Usually when we look at the markets overall, some of the more volatile months in the marketplace are September and October. So in general, once we get into September, I was going to start talking about looking at different creative ways of hedging different stock positions that you might have or your overall portfolio. Nobody knows why September and October can be crazy volatile, but last year it was December. It just seems like as the end of the year approaches is when the volatility creeps into the marketplaces. So with all that being said, that's what we're going to look at today. And I'm going to stick with Apple. We've talked about managing your position, and we looked at Apple after a little bit of a downturn that underlying stock has had. And that stock has been more volatile lately because of discussions with what's going on with China and trade talks, et cetera, has added a lot of volatility just to Apple in general. But Apple had a big update yesterday. It was up about 9 points, and guess what? It gave it almost all back today. But I always find Apple interesting in that whenever there's just major news in the markets, it seems to track whatever losses in the S&P 500 index. If I look at the SPX index, and I actually get down to percentages, the SPX today was down 2.93% on the market. And if I look at Apple was down 2.98%. So it's just kind of interesting how Apple, as the market goes, so does Apple. And Apple finished down $6.22 on the day. So let's say, I know that there's a lot of people out there in Options Playbook Radio land that probably own shares of Apple. So we're going to start by looking at potential ways to protect your position in Apple. We'll talk a little bit about some of the indexes too today, but you can apply this to a lot of different stocks. Now, Apple's a good stock to talk about because it's a $200 stock, and so just the fact alone that it's a $200 stock means that the option prices are going to be a little bit inflated relative to a $50 stock. But then again, it's not a $1,000 stock or a $2,000 stock like Google and Amazon. So overall, I think it fits a general way to look at the marketplace as far as a lot of the FANG stocks are just a lot of positions that a lot of people might have inside their account. So you have one particular stock, you'd like to trade it. I'm going to start with a unique way to look at trying to cover yourself in case of a catastrophe. Now, with most of these stocks and with the way the volatility is, the hardest thing to do is all of a sudden we've had this big news event. We had this big indicator in the bond market that is screaming recession warning of just the global economy, not necessarily just U.S. They're saying about the global economy. And it starts creating concerns. The VIX starts going up. Everything becomes more expensive. So we've already kind of missed that opportunity. If you were thinking about, I want to get some protection on going into the new year, well, that opportunity is already gone because the volatility is already quadrupled all the way across the board. So at least doubled. Let's not say quadrupled. So in this instance, what I'm going to look at is everybody knows you can buy a protective put in Apple. And if I were to just go out and buy a protective put, I would want to get some time under me. I'm going to look at the September 20th expiration, the normal monthly expiration. That's 37 days out. So if I were to buy some protection 37 days out in Apple, we see the stock at 202.75. So I'm going to look at the 200 strike. It just makes it simple to talk about. That's $2.75 out of the money. And we see that 200 strike is trading at the midpoint for about $6.50. All right, so let's do the math. We have the stock trading at 202.75. $6.50 isn't a ridiculous amount to pay as far as protection is concerned. So $6.50 on a $202.75 stock is about 3.2% or about 3.25% if you want to just make the math simple. And then if you put in the deductible, which is the difference from where the stock is at down to the strike price, it's the way we look at protected puts, that adds another $2.75 onto the total cost, because you got to think your insurance doesn't kick in until it gets to $200. So that means the total cost would be the premium plus the deductible, or $9.25, and that's about 5% of the total stock price. The stock was up $9 yesterday. So that's an okay way to approach this is to buy some puts right now, but a lot of people just can't pay that $6.50. They know that it's probably the best thing to do, but they just don't feel like paying it to get into the trade. Okay, so here's my proposal. Let's sell some option contracts. Now, we're saying we own 100 shares of Apple, so I don't want you to forget this concept. But I'm going to go into the options world and use some of the strategies that we have looked at around earnings. And what we're going to talk about doing today is going to be a back spread with puts. All right, so we're going to sell one option contract to hopefully pay for two option contracts. But this is an insurance product, so if we want to get it to the point where we're going to pay or have that short option pay for the entire cost of the two options that we're going to buy, I think you got to make too wide of a spread. So if I'm thinking about using a back spread with puts, I like to call it the pay later put. In other words, you look at selling a put on the stock that you own, you buy two puts. So one of the puts is going to be covering the option that you sold, and the other put's going to be covering the stock that you have on. Now, if the stock continues on up, and all of a sudden this recession warning all becomes a hoax because of quoting or some reason or rationale behind it, and the stock market goes screaming back up, I just don't want to have to spend that much on my protection. And that's what this protected put will do. But if I'm wrong and the market goes down and it just kind of trickles on down, well, that's the worst case scenario for the back spread with puts. And that's why they'll sometimes call it a pay later put. If the stock will drift down towards the long strike of the two puts that you're buying, well, and it just stops right there, that means your insurance doesn't really help you out, and you end up having the maximum loss on your put, okay, on your position, I should say, i.e. your back spread that you put on. So it's called a pay later. Like if the market goes up, you're going to pay a much lower cost right now, but if the market just kind of drifts down, you're going to have to pay for that insurance anyways that you were willing to pay for up front. But if the market really tanks, guess what? You're protected all the way down to zero. Why? Because you have an extra put. So it's an interesting way, an interesting trade to do as opposed to just buying a protected put outright. So let's do it. Let's do it. Okay, so here's our paper trade. And as always on Options Playbook Radio, this was never meant to be a recommendation, but we're going to look at this put option. Okay, so once again, we are taping. It is Wednesday. The markets are closed at this point in time. We had a pretty decent down day in the markets overall. Apple joined in on that down day, down about almost 3% on the day. The markets are closed. It is Wednesday, the 14th of August. The stock closed at $202.75. We're going to look at the 200 strike to give us a little bit of protection. But in this instance, we're going to end up actually selling that $200 strike. And then we're going to use the proceeds to try to buy two of the 195 strike puts. We can do this entire trade for $2.55 to my account. All right. So another way that I can say this is that I'm going to sell a put credit spread to help pay for an extra put. So by doing this, I'm going to have a margin requirement. That put credit spread is 5 points. So if I add the $2.55 onto my $5 margin requirement, I'm going to come up with $7.55. Now, that's my total risk in this scenario is that $7.55, but I also do have a little bit of a deductible here that I have to take in. So overall, it's $7.55, which is my total requirement if I went all the way to expiration and that underlying stock stopped right at the 195 level and just sat there and the options expired, that would be my maximum risk, right? Because if it continues on down, I have an extra put, and that's going to help offset some of that risk along the way. Plus, I got to add that deductible, just like we did on our protected put, which is $2.75 plus $7.55. Now we're $10.03 or 30 cents. I'm sorry, $10.30. Divided by 202.75, and we see in this instance we're talking just about 7% is about where we're at overall, as opposed to our protected put, which is 5%. Okay. Whew, that was a lot. Now, what does this do for us? Well, the total cost then of our trade is now $2.55, as opposed to buying that put outright, which was $6.50. It still gives us catastrophic protection. If Apple wakes up tomorrow and it's down at 100, guess what? We're protected with our $202.75 stock. We can put it to somebody at the 195 level. So we are protected on that 100 shares all the way down to zero. Now, the worst case scenario here is that the stock actually just flounders and it just kind of hangs around right at this level and slowly drifts lower and drifts down towards your long strike. Because remember, we sold a credit spread to help pay for our extra put. Now, here's the good news, and you should be happy with this. If the market goes flying back over the next week or so, if the market starts going back up, I only have $2.55 put into this spread. That's all that I have to start with. So if the market goes up, all my options would expire worthless, and I would only lose that $2.55 as opposed to that $6.50 if I actually just bought the 200 strike outright. Another good news here is that we got 37 days. This isn't a short-term scenario. We're talking 37 days of protection from putting on this back spread. And it's just an interesting way to look at it. So I know a lot of people get intimidated, especially after a big move. If I look at the volatility on this 37-day option contract, it's quite high. It's 31.3% for that 200 strike put with a September 20th expiration. And a lot of people look at that and say, I don't want to pay that vol. I don't want to pay that price. Apple will just come back anyways, and then they just play the hope game and say, I hope it comes back. This is just an interesting way to, actually we're looking at about a quarter of the total cost to buy that protected put. Now, once again, it makes sense, though, that if you are a little bit wrong and the market just kind of goes down a little bit in this instance, and it does it, and you wait all the way to the expiration date before you get out, that's where the name pay later put comes in, because I pay that $2.55, but the maximum that I could actually lose on this trade would be an extra $5 or $7.55. So everything with options, it's all about trade-offs. Which one do you like and which one don't you like? Now, with all that said, I'm getting a little bit long-winded, but you don't want to get too fancy with this type of trade. Let's just look at just doing a put spread. Are you really worried that Apple's going to go to zero? Well, if you're not worried about that, well, why don't we go on out and just buy that 200 strike put and maybe go down whatever you feel. You want to go down 10%, you'd be looking at the 180 strike, or another 10 points down to 190, you'd be looking at that strike. If I look at those option contracts, they're trading for some decent premium too because the volatility has increased. The 180 strike would be, right now at the midpoint, it's trading for 175. The 190 strike is trading for 3.25. So you can greatly reduce your cost overall on your protection if you're willing to basically reinsure and sell a put a little bit lower down. That's another way to think about it. So you're just basically using a bear put spread or a put debit spread to lower your cost of insurance, but then you don't have the protection all the way down. You're only protecting for a percentage, maybe 15 to 20% move to the downside. All right. Whew, that was a lot. Let's see what the markets do tomorrow, and that's going to be it for this episode of Options Playbook Radio. If you have any topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.